Welcome to the Explainer. Okay, so uranium prices are on a tear. We all see that. But you know what? The real story here isn't just the price going up. It's the battle that's raging just beneath the surface. Today, we're going to decode that very conflict, the one that's going to separate the huge winners from the ones that, well, inevitably wash out in this bull market.
And you've got to forget the simple bull versus bear story. That's not what this is about. The real drama, the thing you need to be watching, is a fundamental clash between two completely different kinds of capital with totally different goals. And trust me, understanding that difference, it's everything. So on one side, you have what we'll call super-cycle capital. This is the smart money, right? The disciplined investors playing a long game. They're dialed into the real structural supply problems and the actual geology. Then, on the other side, you've got the tourist money. This is the hype-driven cash just passing through, chasing whatever's hot this week. Here's a great way to think about it. Imagine the uranium market is a packed stadium in the middle of a blackout. Everyone can see that scoreboard glowing bright green. Prices are up. Everything looks fantastic. But here's the catch. Almost nobody really understands the complex wiring under the seats that's actually powering the whole thing. The tourists? They're just staring at the scoreboard. The super-cycle investors? They're the ones who know how the power grid works.
Okay, so let's dig in. First, we've got to identify the antagonist in this story, the tourist trade. This is all the market noise that you absolutely have to learn to filter out.
So, what is tourist money, really? Well, it's that wave of generalist funds and, retail investors who kind of show up late to the party. They aren't actually investing in uranium the commodity, they're just trading the theme. They'll chase any ticker that's screaming up 15% on the day, they crowd the market, and you better believe they are the first to run for the exits at the slightest sign of trouble. And that is what creates these insane, violent price swings.
And the companies built to attract this tourist money? Oh, you can spot them a mile away. Their whole business model isn't about producing pounds of uranium. It's about producing paper. Their main asset isn't a drill program. It's a slick-looking slide deck. They're constantly watering down their shareholders with new equity raises, and they pivot their whole story to match whatever hashtag is trending this month. What they're really offering is pure volatility, not substance.
All right, enough about the noise. Let's flip the coin and look at the other side of this thing. Over on the other side of the stadium, you've got the hero of our story, the companies that are actually built to last the whole cycle. This is the signal you need to be looking for.
So pillar number one for a solid project is that it is built on a foundation of proven geology, not just some flashy sales pitch. We're talking about projects in the best jurisdictions, in basins that have a real history of production, often right next door to the major players. And, crucially, they have a defined, compliant resource. That means real pounds in the ground, not just wishful thinking on a map.
Next up, their exploration is deep and it's methodical. This is not about drilling a couple of random holes just to get a press release out. No, this is a focused, targeted program that's designed by qualified pros to genuinely de-risk the asset, to actually scale the deposit, and to add real measurable value over time.
But you know what? This might be the most crucial piece of the puzzle, their capital structure. The best projects, they often bring in a major strategic partner, think a state-backed utility or a big operator, to fund all the expensive exploration. Now, what does this mean for investors? It means the original company and its shareholders get all the upside of a discovery without being constantly diluted by endless equity raises. The money is tied to hitting real milestones, not just fuzzy goals to keep the lights on.
So this all sounds great in theory, right? But how can you actually use this framework to cut through all the noise yourself? Let's build a practical filter, a little battle plan you can use every single week.
And here's the good news. You don't need to be a geologist to put these ideas to work. There's a really practical checklist you can use to start separating the true super-cycle contenders from all those short-term tourists. All you got to do is run any company you're looking at through this simple 4-point filter. Number 1, pounds versus pitch. Does it have a real compliant resource or just some pretty marketing art? 2, jurisdiction and neighbors. Where is it and who's next door? 3, capital and partners. Who is footing the bill? Is it a serious partner or just a constant stream of retail money? And finally, number 4, timeline realism. Could this company survive and even make progress if the market went sideways for 2 years? Or does it need constant hype just to exist?
And let's be crystal clear here. If a company fails these checks, it belongs squarely in that tourist money bucket.
Now, does that mean its stock can't go crazy in a frenzy? Of course not. It absolutely can. But it means it's a short-term trade, not a long-term investment. It is not a core holding for the real super cycle.
Which brings us right back to our stadium. So let's leave it with a final thought. When all this hype eventually fades, and it will, and those stadium lights finally flicker back on, the difference between real substance and a good story is going to be blindingly obvious. The only question you have to ask yourself is, who's going to be left standing?